Hi everyone, and welcome back to another episode of attempting to turn 10k to 100k over time. So last week was quite a eventful week, right? So if you recall from what I said in my last episode, I will be looking to deploy capital in light of any opportunity there is from volatility, because there was a Fed announcement last week, and there was interest rate cuts, and then from there on, depending on what Powell says, I'll be looking to deploy capital, and hopefully in my ideal situation, right, it's a statement that's a little bit more hawkish compared to what actually happened. So I was expecting volatility to the downside, and this giving me an opportunity to buy at the dip. But what actually happened was otherwise. So I didn't have the opportunity to add anything, which is why I'm still not buying any stocks yet. But that said, if you have followed my calls last week on some companies I was looking at, you probably would be sitting in the green for some of these companies. So let's get right to it. So what happened last week? So let's scroll up. Last week, three major events happened. So number one, the Fed cut interest rates by 25 basis points and more or less strongly hinted that there will be two more rate cuts coming up for the rest of the year. So this is extremely bullish. Why? Because there's certainty in the market, and this is exactly as what the markets expected. So they wouldn't have to adjust their current strategy or their risk appetite, right? Instead, they could even be looking to deploy more capital, moving away from your risk off assets to your risk on assets, because your returns on your treasury use are going to be even less than before now, right? So it makes sense to go on to risk on assets. And the dot plot, right, more or less indicated there will be more rate cuts coming up as well. So the market is very happy with that. And at the moment, right, so the reasons for the rate cut in Powell's statement, right, was because there is some weakness showing in the job market. And so they want to cut rates to address this concern. And they are also gradually warming up to the idea that Trump's tariff inflationary impact is one-off in nature. But at the same time, Powell being like as he's always does, he's open to both mandates. So if inflation risk remains elevated, they could pivot from this rate cutting strategy again. So summary of the economic projections provided by the Fed, right? So GDP forecast is raised for 2025, 2026, and 2027. So if you listen to what I mentioned in my previous episode, rate cuts are only bearish in a situation where there is a recession coming up. So the cut is only bearish if it is used to counter a recession. But looking at how the Fed actually increased GDP forecast, right, it means that actually it's not a cut to the recession, and actually the economy isn't that bad. But they're just cutting rates to counter short-term weakness in the job market. And they also, at the same time, mentioned that unemployment rate forecast for 2025 remains unchanged, lowered from 2026 and 2027. So this is very, very bullish for the markets. So I expect the markets to continue rising going ahead. And PCE forecast also unchanged for 2025, raised for 2026, and unchanged for 2027. So like what I mentioned earlier, there is some elevated inflationary risk that they're looking at. So in summary, I think we're still bullish and we're not cutting in a recession. And another particular thing to note is that the new Fed voting member that I just joined recently projected for 5 rate cuts. So if you expect Powell to be more or less moving on from this position sooner or later and getting replaced by a Trump ally, you're probably going to see a lot more rate cuts, stronger than expected, because this new member that joined, Stephen Miran, sorry if I pronounced his name wrongly, he's actually someone who's like an ally to Trump. So if we see this trend continuing, we're probably going to see more hawkish Fed members join the Fed. And number two is Nvidia actually investing $5 billion directly into Intel stock and $23.28 per share. So also another thing to note that is the US government themselves recently invested into Intel. And so what you can see from this, so Intel shares, right, after this announcement, popped quite heavily. I think if I'm not wrong, it went up to 30% the opening at one period of time, but it's since put back slightly. So what are the pros of this? So this means that Intel and Nvidia through Intel is investing directly into capex in the US, which is aligned politically with the government's agenda for chip manufacturing capacity and capabilities. So at the same time, right, Intel is probably gonna get more support from Nvidia through maybe their manufacturing orders as a client, or through like a cross-link product. So probably they can share their technology, their expertise, and you will see Intel start producing great products again, taking product DNA from Nvidia. But what are the downsides to this whole transaction, right? So 5 billion actually isn't that much, considering the amount of capex needed to turn Intel back into a manufacturing powerhouse. So actually, the company themselves invested more than 25 billion in capital expenses for fiscal years 2022 and 2023, followed by another 24.9 billion in 2024. So the 5 billion provided by Nvidia actually, while still significant, it isn't that much considering the entire amount that Intel actually has to spend to turn the business around. And number two, the company culture needs a massive turnaround, right? And talents don't find Intel attractive anymore. This is evidently showed with the amount of CEO changes that Intel has in recent years, right? Pat Gelsinger was a very prominent CEO in the whole chip space. He himself resigned from Intel. So what is my take on all this situation? So it could take some time to pan out the turnaround, but if you believe in the turnaround story, now will be the best time to enter some shares, because if there is more uncertainty, there's more risk, and there's higher potential for reward. But personally, I will adopt a wait and see approach just because of how much work and capital is needed to turn Intel around. But you could do your own due diligence, and perhaps Intel could be a multi-bagger in the years to come, considering how beaten down the company has been for the past decade or so, right? Number three, Elon buys back approximately 1 billion worth of shares of Tesla stock. So this spurred more insider buys, and I think overall this is a very good situation for Tesla shareholders, because the company in recent years has fallen short in terms of products competition with its the Chinese counterparts like BYD, and with the founder CEO back into focus, right, moving away from all its political adventures in recent years. I think this is very good for Tesla shareholders. There could be more upside to come, especially if Tesla manages to release new products and they achieve whatever they set out to be. Optimus, their AI, the robots, self-driving, everything. There's a lot of addressable market to reach out to, exploit, and to capture. And I think this would be good for Tesla if they get back on track, especially considering that Tesla is sort of more or less lagging the other Magnificent Seven stocks in terms of its share price appreciation. And so looking into the general market landscape, right? So as I mentioned before, September is usually a bearish month, but we haven't seen that form of bearishness yet. I was expecting the Fed announcement to provide some volatility and provide the seasonal dip that we see in September to enter shares before the year-end rally. But that didn't happen, so maybe this is an anomaly because of the Fed cutting cycle, right? Looking at fear and greed, it's still just recently entered the greed territory again, but there is some room to go before it hits extreme greed. So this is one thing to note. Market momentum is in the greedy territory, very far away from its 125-day moving average, but I don't see any short-term catalyst that could drive this thing down. It may need some form of need something new to the market to spur any bearish pullbacks right now. Stock price strength, extreme greed. Stock price breadth is neutral because it's mostly just the Magnificent Seven AI names that are pushing the markets higher, while we can see your other industrials or maybe components of S&P 500 maybe lagging behind. Puts and call options, so everybody is very, very bullishly positioned, right? You're seeing like it fallen below the local support in terms of the put call options positioning. Market volatility, the VIX, it's at neutral, also at quite a low. So in my opinion, that there should be a pullback coming up considering how excited the market is. But what actually causes it will be anybody's guess. But it could even be a technical profit taking kind of situation. But looking at how bullishly positioned we are now, probably not so soon in my opinion. Right. And yep, after the Fed statement, the markets more or less have confidently positioned themselves for 3 more rate cuts this year, as indicated on this tool on CME. We're seeing a 78% chance of 3 rate cuts to end the year. So bullish, right? But on a weekly basis, the M2 money supply and your FINRA margin debt wouldn't change much. But as you can see, there's still more liquidity coming in the market, so it's better to stay long. Yep, your interest rate also declined after your Fed cut announcement, so more or less everybody's aligned. Looking at valuations, right, Shiller PE ratio, there is some room to go before it hits the dot-com bubble high. So I would just take this with a grain of salt because, as I mentioned in previous videos, right, we have a lot more money supply in our system now. So perhaps valuation matrix couldn't be that followed to the book nowadays. But I'm not sure if these are famous last words, but do not, in my opinion, you should still stay deployed in terms of capital, but you shouldn't go all in if you have not been actively investing for the past few years, and your portfolio isn't as structured and as built up. So if you're entering from scratch, I believe that the best option to take is to go in slowly instead of going in at one shot, which I think is a bit more risky as the market hits up further. Price to sale ratio is at past. It's very high now, right? PE ratio still looks good, so I think this is the best charts I would say if you're a bull and looking to deploy, but you're feeling a little bit scared because of valuation. But looking at the PE, there is still some room to go. So I think we should still stay invested regardless. Just don't go all in. Okay, looking at COT positioning, I explained in the previous video on my weekly market outlook series of how you should use the COT positioning to help time reversals. Maybe you can look at that the episode for reference. So looking at USD, I think it should remain weak for now, especially as the Fed cuts rates further, right? There'll be more capital flowing out from your treasuries to perhaps go into other perhaps to your other countries' stock indices and things like that. Yeah, mostly flowing to risk on assets, which you may not need USD for. Now looking at let me zoom out a little. Looking at the S&P 500, I still feel that we're still bullish for now, though the positioning indicates some form of extreme positioning. We could see some form of volatility, but at the moment, like I mentioned, there's no catalyst. So until that happens, we should see this start to range a little, like what we've seen previously, right? So I wouldn't use this as a indication to just go short right now. Same thing for the Nasdaq, right? It's even better position compared to the S&P. I think we should remain bullish. Likewise for the Dow Jones. And I'm most bullish with the Russell 2000. I feel that there's more room to go for small cap stocks. But another thing to note is that a lot of retail investors are back in the market. Like this Zero Hedge article has shown, retail arm equals parabolic, 10 straight green days and counting. So actually I would like to ask everyone out here, and leave in the comment section if you're seeing this, right? Are you seeing your friends share and talk more about stocks recently, more often? Are they sharing their gains and wins only? So I like to use this social kind of indication of whether we are near a local top or a local top or the top for the next few months at least for now. So if a lot of your friends are talking about stock, usually until dragging on a few months, the markets will hit up higher, and then suddenly, right, something bad happens and the crowd goes silent and everything just goes back to 2022 and 2023 period where your friends are started to stop talking about stocks and the market pulled back. So I think as a long-term investor, these are the opportunities where you should be selling to them, and and when they are scared, that's where you should start buying. It's like the Warren Buffett quote, right? I think everybody knows that quote. So I think for now, if you're seeing a lot of your friends starting to buy stocks, it's not the time for you to go heavy. You can continue staying invested to get skin in the game, but like as I mentioned, don't go all in. So that's the market summary for the past week, right? So looking at the economic calendar for the week ahead, let me zoom in a little in case you can see. Basically, there is nothing much, right, from the US market point of view. There is some manufacturing data, probably speaking, and yeah, your GDP data, they're mostly lagging, right? And your core PC price index. So US economic indicators on Tuesday, you have some PMI manufacturing data. Obviously, I feel that the higher, the better to some degree. So it means that your economy is still strong, which helps push the entire view that we're not cutting the recession, right? So this will be bullish for the market. Same thing on Thursday, where we see final GDP for a month over, for quarter on quarter change. So the higher the better to some degree. Friday core PC, so the lower the better. So we're not so Powell wouldn't be like getting some second thoughts about cutting into higher inflationary environment, right? But in my opinion, unlikely to move the markets much unless we see a sharp variance in the results numbers. Number two, Powell will be speaking again on Wednesday. So it's important to see if Powell sticks to his very dovish stance on which last week, right, where he announced the Fed cuts. So if he sticks to a dovish stance, meaning more rate cuts, I think that it could spur the markets higher slowly and gradually. But if it starts to inject uncertainty, like, we need to adopt a wait-and-see approach, remain data reliant, it may cause some form of short-term volatility. But I think the most likely outcome is to stick to A, because it's just been a week since the Fed cut and the statement. Number three, earnings. So quite a weak earnings wise, except for Tuesday, Micron. So it gives an indication on the whole AI and semicon chips market demand and outlook, right? So obviously this might move the market a little, especially the chip stocks. And on Thursday we have Costco. Well, Costco itself is a popular retail stock. It's a big S&P company, but I think how its announcement itself wouldn't move the markets, right? But mostly its own stock. But it provides an indication of economic and consumer health going ahead. So quick takes. So I think that the markets probably linger upwards with inflows from less risky assets to risk-on assets, which are your stocks. So valuations are pretty expensive right now, so cautiously enter. This is not the best time to go all in, but to take smaller positions as we go up. US indices, I will remain cautiously bullish. I will prefer small caps based on my risk preference. So last week, let's take a quick recap on the stocks last week that I recommended. Number one, Brute. Let's see how it performed. So I will use daily charts, right? So I think if you bought into Root last week, you probably are in the green. This is where I started around here. You're slightly in the green because the market pulled back and went up. So this week, right, I'm also looking at Root again, expecting a breakout. So if it breaks out, I think it might go up back to at least the $120, $130 level eventually. So I think it's a pretty good solid stock to add into. If you look at its fundamentals using Stock Penguins too, like I showed before previously, it's fundamentally is growing pretty strongly, right? Let's see it pass 10 years quarterly. Yep, it's growing very strongly revenue wise. Net income positive now, right? So I think a pretty solid company to invest into. Valuations wise, it should look attractive as well. Let's take a look. This is the price to sales ratio. Yeah, it's looking pretty decent at 5.2. Okay. And the other stocks I was looking at was Open. I think Open didn't do much last week after the announcement of Spotify's COO joining as Opendoor as its CEO, and them having a huge compensation package contingent on Opendoor's share price. So if Opendoor hits, if I'm not wrong, $30, right, the management will get paid a lump sum. So I think Opendoor might be a good might have some chance to enter, especially if it covers the gap, or if you can't wait, right, and you're okay to hold through the volatility, maybe adding it at the local low support here might be not bad, so near $8 plus range. So, but I personally would look at either $7.50 or slightly lower at $6. So I'm not in a rush to enter open door for now, but I think it might be a long-term play considering how bullish the CEO is. If you listen to his recent podcast, he conducted just 24 hours after joining the company, right? Number 3, UNH. So UNH, I think, was the one that disappointed, but it pulled back nicely, right? So it pulled back nicely. I think this was where there was a gap previously, so I think it might be used as a support. I was thinking to maybe look into entering UNH myself this week. Yep, it's number 4 on my list. Number 4 for last week, I was talking about this stock, Eli Lilly. Well, nothing much as well, still taking its time to go back up, but I believe that it should hit the $800 range soon if this current support of around $740 holds. Number 5, Unity. So yeah, Unity, if you entered, you are probably, well, if you entered at the Friday 1-day open, right, probably in the green, right? But let's see, there is a resistance here that it could have some trouble breaking through, right? But if it does break through, I think 58 high 50s isn't an issue, right? So looking at the stocks this week on my watch list, number 1, Root, as I mentioned previously. Number 2, Figma. So Figma is an interesting one. So it just IPO'd recently. I think if you are someone that just entered the workforce recently, or you're in school, you probably use Figma to create some mock-ups and things like that. So interesting case is that it broke through the previous gap down price, and it's still holding relatively here. So if prices open and remain steady above $57.40, I might choose to enter and just hold and see what happens, since it's sold down quite aggressively from its IPO price. Yep. If you want to study more about Figma's fundamentals, right, you can just use Stock Penguins and just look at its financials. You can go through it. There's data for its financial statements and even its key financial ratios and historical, well, not really historical earnings performance, but because it's just IPO. But there's no earnings call yet because but the company just went public. But you can take a look. Oh, there is one on September the 3rd. You can see what the company's prospects are by looking through the management call. The Figma is on my watch list as well. Number 3, Novo Nordisk. So Novo Nordisk is another healthcare company that's sold down aggressively over the past 1-2 years. So recently, it is making a comeback, right? I wanted to long some shares at $55 region, but my order didn't get executed and it just went up. So sometimes, right, if you are looking at the long term, maybe just take a market order, because that little few cents and dollar difference wouldn't matter that much in the long run, but missing out the trade would. So I'm looking to see if I could if prices get hold above this resistance area and make it turn to the support. If it does, I'll probably take a long and then see if it could fill the gap at $68. But I think this is a good long-term hold. Fundamentally, the company is still performing strongly, though there is some jittery around competition in this space from your Eli Lilly, your upcoming companies like Hims and Hers. But overall, this is still a very, very strong company with a lot of moats and very strong, decent pricing power. It is a market leader in the weight loss scene market as well. So let's see what happens. I think this is a company that I would like to add to my long-term portfolio because it's a contrarian bet against the mass market, while at the same time, it's a company with solid fundamentals. And number 4, UNH. UNH and Novo basically has the same story like I mentioned earlier. It's looking good if it manages to hold at this price level, and I'll take a long. Yeah. And lastly, Tesla. So Tesla, it's an interesting one. I'm not really in a rush to buy Tesla stock, but let's see if it could hold and cover this little gap and use it as a support for it to go back higher. But I think might not be much meat. Tesla seems has a lot of things to prove, but let's see. This is a KIV for now. So that's all for this week, and all the best.